As I speak to you right now, the markets are open and NVIDIA stock is trading live at $176.26, down approximately 1.8% on the intraday session so far. If you are watching the ticker, you are seeing a lot of red on the screen. And the immediate reaction for most retail investors is to view this as a standard consolidation, a breathing room moment after the relentless run we have witnessed over the last 18 months. That is the expectation, that this is just another buying opportunity in a long line of buying opportunities that have minted millionaires out of ordinary savers. However, the reality of what is happening on the tape today is far more complex and, frankly, a bit more concerning for those who are not paying attention to the institutional flows underneath the surface. The price action you are seeing right now at $176 is not just a slip. It is a battleground where the smart money is starting to hedge against a narrative that might be getting too heavy to carry. The expectation is that AI spending is infinite. The reality we are seeing in the order books today is that the biggest spenders are starting to blink, and that hesitation is what is driving this current downward pressure. We need to look past the surface-level green and red flashes and understand why this specific price level matters more than the all-time highs we saw just a few weeks ago. When you look at the chart right now, that drop to $176.26 represents a rejection of the $180 level, a psychological ceiling that traders have been watching like hawks. The volume today is telling a story of distribution, not accumulation. Unlike previous steps where we saw immediate aggressive buying from retail traders using apps like the Robinhood app or the Fidelity mobile app to snatch up shares, today's movement is sluggish. There is a heaviness to the stock. It is struggling to find a bottom intraday, and every time it tries to rally back toward $177, it gets hit with another wave of sell orders. This suggests that the sellers are not just day traders flipping for pennies. These are larger lots, potentially institutional rebalancing, exiting positions to lock in gains before the end of the year. The market is digesting the recent reports that major tech giants like Meta and Google are aggressively accelerating their own internal chip programs. This is the elephant in the room that everyone knows is there but refuses to acknowledge until the stock price forces them to. The expectation has always been that NVIDIA would remain the only game in town forever. The reality, which is starting to price in today, is that the company's biggest customers are becoming its fiercest competitors. That transition does not happen overnight, but the market is forward-looking. And right now, it is peering into 2026 and getting nervous. Let's talk about the broader context of this movement because it is impossible to view NVIDIA in a vacuum. You have to look at how it correlates with other major movers. For instance, when you look at Tesla stock or Apple stock today, you see different narratives playing out. But NVIDIA is acting as the anchor for the entire semiconductor sector. If NVIDIA sneezes, the rest of the market catches a cold. We are seeing a rotation. Money is moving out of the high-flying hardware names and looking for safety or value elsewhere. This is where tools like Schwab Intelligent Portfolios or similar automated systems often kick in, rebalancing portfolios to maintain asset allocation, which can exacerbate the selling pressure on a day like today. If you are engaging in self-investing or trying to manage an individual brokerage account, these automated flows can feel like a tidal wave against your position. You might be bullish, but if a million passive algorithms decide it is time to trim NVIDIA exposure by 0.5%, the stock is going to drop, regardless of your conviction. That is the mechanical reality of modern markets that often gets overlooked in favor of headlines about AI robots or new data centers. The skepticism we are seeing today also stems from a growing vocal minority of analysts and famous investors who are starting to draw parallels to the year 2000. You have likely heard the comparison to Cisco Systems during the dot-com boom. It is a terrifying chart if you overlay it with NVIDIA's current trajectory. The expectation from the bulls is that this time is different because AI has real utility where .com websites often did not. The reality is that valuation models essentially break when growth rates normalize. If NVIDIA goes from growing at 200% to growing at only 30%, which is still incredible, the multiple contraction could be violent. That is what the bears are betting on today. They are not betting that NVIDIA will go bankrupt. They are betting that it will become a normal company. And a normal company does not trade at 40 or 50 times sales. This tension is palpable in the price action at $176. Every tick lower is a test of that hyper-growth thesis. Now, I want you to take a moment and think about your own positioning here. Comment below how many shares of NVIDIA you currently hold and what your average entry price is. Are you sitting on massive gains from the double digits, or did you enter recently near the highs? I am genuinely curious to see where the pain points are for our community because that psychological aggregate determines where the panic selling usually starts. When we examine the institutional landscape, the activity is fascinating. We are seeing huge blocks trading on dark pools, which usually indicates that funds are exchanging hands without wanting to disturb the public market price too much. However, the fact that the public price is drifting lower suggests that the buyers in those dark pools are demanding a discount. They are not willing to pay the premium anymore. This is a classic sign of fatigue. For those of you who use Fidelity Investments or perhaps have a Fidelity brokerage account, you might have access to some of their research tools that show flow data. It's worth checking because often you will see that while retail sentiment remains high, people buying fractional shares on Robinhood investments or adding to their position via the Robinhood stock trading interface, the smart money flow indicator is pointing down. This divergence is one of the most reliable signals in trading. When the crowd is buying and the institutions are selling, the price almost always resolves in the direction of the institutions eventually. This brings us to the fundamental argument that is raging right now. What does NVIDIA actually do that justifies a multi-trillion-dollar valuation? We know they design the chips, the GPUs that are the engines of modern computing, but more importantly, they own the software ecosystem, CUDA, which has effectively been a walled garden keeping competitors out. The expectation is that this moat is impenetrable. The reality, however, is that software moats are sticky, but they are not eternal. We are seeing huge investments from competitors and open-source consortiums trying to break that lock-in. If you are involved in online investing or looking for investment help, you need to understand that you are not just buying a chip company, you are buying a software monopoly. If that monopoly weakens, the premium on the stock evaporates. We are seeing early signs that large clients are willing to spend billions to build workarounds to avoid paying the NVIDIA tax. That doesn't mean NVIDIA's revenue collapses tomorrow, but it means the margins, those juicy, beautiful gross margins that Wall Street loves, could come under pressure sooner than anticipated. There is also the macroeconomic angle. We're in an environment where interest rates are a major topic of discussion. High rates usually hurt high-growth tech stocks because their future earnings are discounted more heavily. While NVIDIA has so much cash they're practically a bank themselves, the valuation compression affects them too. If you are using investing sites or managing a SoFi active investing account, you have to keep an eye on the 10-year Treasury yield. If that spikes, NVIDIA often takes a hit. It's all interconnected. The days of simply buying a ticker because AI is the future are over. Now you have to be a macroeconomist, a technical analyst, and a semiconductor engineer all at once to really understand the risk you're taking. For those who prefer a hands-off approach, something like a SoFi robo-advisor or an intelligent portfolio might diversify you away from this single stock risk. But for those of us watching the tape today, the volatility is the point. Let's dig deeper into the specific selling pressure we are seeing on the interactive brokers trading platforms and other sophisticated outlets. The options market is showing a massive buildup of put open interest at the 170 and 160 strikes. This acts as a magnet. Market makers who sold those puts have to hedge their exposure as the price drops, often by selling the underlying stock. This creates a negative feedback loop. Stock drops, market makers sell more to hedge, stock drops further. This gamma squeeze to the downside is a real risk when you have a stock that is as crowded as NVIDIA. Everyone is on the same side of the boat. If the boat tips even a little, the rush to the other side can capsize the price action temporarily. We are seeing hints of that instability today with the chop around $176. It feels like the floor is a bit slippery. Despite the gloom of the intraday drop, we have to acknowledge the incredible strength of the underlying business model. NVIDIA is not just selling chips, they are selling entire supercomputers. They are selling the